Welcome to my stream. I'm just gonna give a couple of minutes. Just doing a time check to make sure everything is working. Can you just yeah, hold on. All right. I guess let's begin the stream. So just a few things for housekeeping. Uh, so please bear with me. This is my first time. I'm doing this and hopefully make sure everything works. So please forgive any mistakes I make for the first time. What I'm going to be doing is after every couple of slides, I'm going to pause to look at what questions you have and try to answer them. Now, those who cannot actually type the questions in, you guys have me on WhatsApp. So please just reach out to me and I will try to cover those questions as well. Then so the other thing is a huge shout out to my daughter Neha, who has helped me put this together and helped me, the me being so technologically challenged. She has helped me through all this. She has her own YouTube channel. She inspired me to basically, do this. And her YouTube channel also, I'm going to put for everybody. She's a really nice singer, so opportunity for me to kind of advertise her here, shamelessly, if I may. So there you go. Can everybody hear me? Can somebody just make sure you can hear me? Okay, perfect. Uh, Last but not the least, yeah, there's some questions. Like I said, if you have, just post them on WhatsApp if you cannot post them. All right. So with that, I'm going to now share my screen. So just give me a moment to just make sure everything is set up properly. Okay, just all right. Okay, perfect. Things are working now. Getting there. So I'm going to first flash this disclaimer out. It's a necessary evil, before any of these option trading lectures. I want to make sure that I'm not a financial advisor and this content is for educational purposes. Recognize that options use leverage and can involve considerable loss and not suitable for everybody. The trades that I will be discussing in the future, I do them in my own account based on my own risk appetite. I encourage you to do your own research and go through what if scenarios. I'll be hopefully providing you with those tools to do that. And again, treat all these discussions as brainstorming and, just have a two-way conversation and, live questions and answers. So, yeah, let's go from there. So, I just wanted to say this video is mainly geared towards beginners who have really no idea about what option trading is. Basically, understanding the mechanics of how profits are made using options instead of dealing with actual shares. I'm going to keep on adding more and more complexity to these videos. This one is really down to the nitty-gritty basic details. So a lot of you might be very much familiar, but I still feel free to be engaged and ask questions because there's always different perspectives which enhance your learning. And then I'm really hoping after watching this video, everybody will be really as fascinated to dig deeper in this topic as personally. Be sure to ask questions in the live community chat, which you can access if you are a subscriber. And yeah, let's start digging into this without further ado. So I'm just going to take a break and look if there's any questions per se. All right, so no questions so far. Okay, so first and foremost, why options? Why do people turn to options? So we know that the traditional way of making profits is, for example, you buy stock when the price is low and you simply sell it when the price is high. It's typically one-sided when the markets are going up. What if I told you that there actually exists a financial instrument with limited risk that makes profit not just when the markets are going up, but in fact also you could make some limited profits and do some risk management when the markets are going down in a bear market, or for that matter, when the markets are going sideways. To be more specific, options allow you to use capital efficiently and build a long-term plan so that you can actually use part of your portfolio doing options and enhance your overall portfolio in the long-term markets, which typically, S&P 500, for example, has returned about 7 to 9% over last almost 100 years. So using capital efficiently is something you can do. Protecting your portfolio, taking advantage of volatility when everybody is panicking. And when does everybody panic? When markets are going down. And then creating income when the markets are just doing nothing but going sideways and sideways, when your portfolio seems to be doing pretty much nothing. So the general takeaways that I think, why people go towards options are, first and foremost, think about getting paid to wait out to buy your favorite stock till the price is right. For example, you have a Apple trading at $270, so you think it's too high, so you keep on selling what you call put options and keep on churning profits till Apple dips down to say 265 or 250. Then you actually are buying it. So that's the sort of scenario which we'll talk about later. Important thing is time itself becomes a commodity in options trading. Time you can actually make in your favor. Every day that ticks by, you actually have the probabilities of making profits stacked for you. That's a very important thing about options. Next is, again, we talked about this, controlling 100 shares. A typical option contract is worth 100 shares for only a fraction of the price. So again, adding that leverage component to enhance your portfolio. And then last but not the least, I want to stress that options have a sort of a bad name. I've talked to many people who say, "Hey, that's just gambling," and I can assure you that it is not, because first and foremost, in a gambling Las Vegas scenario, the house is always going to have an edge. But with options, you can actually make trades in which the probabilities are stacked in your favor, say 60% probability of profit, 70 or whatever you want. So with that, and with gaining some sort of a technical edge in the market, either through technical analysis or fundamental, that's one way of thinking about this. You have a better win to loss ratio and a better edge, and that's your path towards, better returns. Again, like I said, this skill, once you learn, you won't look at markets and investing in the same way. So yeah, without further ado, with this introduction, let's start digging into the first strategy of actually what a call option is and how to set up a call option to take advantage of markets going up in general without buying the stock. So again, I'm going to take a quick pause. to just see if there's any questions. I don't see any questions yet. So, all right. So, so let's now actually start digging deeper into fundamentals of options. Basically, we will use this example and analogy to establish some building blocks. So let's start with a simple scenario. A friend's house is currently fairly priced at 100K. Well, good luck with that. Which market has a house at 100K? That's another question. But hey, it's an example. That's all. So so your friend is willing to write a contract. The contract is such that you basically pay him $5,000 upfront for that contract. They are taking a risk on this contract that the house actually does not go up substantially in the next 1 year. It might appreciate a bit, but not substantially, is what their side of the contract is. That's how they are going to benefit. You are taking the opposite risk that the price, in fact, will appreciate substantially and, in fact, go at least above 105. So, what does the contract specifically say? So, you are the buyer. You pay $5,000, which is basically in the options market called an option premium, to your friend who's the seller. That contract, what does it do? It grants you the right. It's just a right, but not an obligation. You are not obliged to do this. It's a right that fixes the purchase price of the house at $100,000. In other words, you can go to the market anytime in 1 year, not after 1 year, but only in the next 1 year, and buy the house irrespective of whatever the market price is. You can buy the house at 100K and then sell it at the current market price. So that's what that contract is. Again, just to elaborate, you purchase that contract for $5,000. You can buy the house anytime in the next 1 year for 100K and sell it at whatever the price is. If the price goes to like 200K, you can sell it and make a profit. So that's what the contract is. So the takeaway is that you are debit 5,000, your friend is credit 5,000. So I'm going to take a look at some questions again. The first question was, can you elaborate on house edge in gambling versus edge in options trading from Neha? Uh, so basically, any house like any Las Vegas house, gambling house, typically speaking, as far as I know, they always have an edge of 51% at least. In fact, what that means is that if you place a bet thousands of times, 51% of the times the house is going to win, you're going to lose. So the probability is always stacked against you. So like on a millions of these transactions, you're always going to lose, the house is always going to win. But with options trading, you can actually make trades with how the market, you can actually make high probability trades. You can say that 60% I have a profit, uh, I can make a profit, 60% probability is what it is, etc., etc. So that's the bottom line here. So in terms of sharing thoughts on candles and seeing where the market is going in the next few days, hours, etc. I'll be honest with you. So this really is mostly a lecture on options trading. Personally, I'm not a great technical analyst and I rely on the community for that. But what I do like right now is markets have been range bound. So, for an options trader, range bound is one of the best things for the markets to be. And yes, I am going to actually go in details in that 100K example, and in fact, how to make how you are going to be able to make a profit, and hopefully that will be more clear. All right. So I think hopefully this will be more clear once I go through this, how you actually make a profit on that 100K scenario. So first scenario is how you can actually make money. So again, remember, just to elaborate, you bought a contract which gave you the right to buy the house at a fixed price of 100K. Again, that is called a strike price. That's a very important term, strike price. So what will you do? The house has gone up to 120K. So you are simply going to go and buy the house at what your contract says at 100K and sell it in the market, which is currently priced at 120. So what's going to happen is from the transaction from step one and two, you're going to make a profit of 20,000. But remember, you paid a $5,000 premium to your friend. So you're obviously going to lose that money. So your net profit from this is going to be 15,000. So how do you lose money? What if the house doesn't appreciate substantially and only goes up to 104,000 in the next 1 year? So let's follow the same steps. Step one is you will buy the house at the contract strike price of 100,000, sell it at 104. That will make you a profit of 4,000. But remember, going back to the premium that you paid of 5,000, you end up with a $1,000 loss. In other words, what does that mean? Is you need the house to appreciate to at least greater than 105,000. And once it's above 105 is when you are going to be starting to make a profit. So hopefully that answers the question of the 100K example a bit. So now let's talk about your friend. First and foremost, what's important to note in terms of the risk to reward is what we typically look at. Your risk is only going to be 5K. The most you can lose is only 5,000. But your profit could technically be infinite, right? The house could theoretically in the next 1 year go as high as it can. So that's for you. Limited risk and unlimited reward. It's exactly the opposite for your friend. The most they can earn is the $5,000 that you gave them in the premium. But they can lose pretty much, you know, technically, theoretically, they can lose infinity, right? That's basically what it is. So let me go back to the question and answer. So I think the question was, what is range bound? I guess what I meant by range bound is not is that it's neither going up nor down. For example, the S&P 500 has been pretty much between like 6,600 to 7,000 almost since like November. So it keeps going up, going down. My hope is that it really won't go way too down because of this crisis right now. That remains to be seen. Nobody knows in this world, honestly. People will just guess. But for an options trader, it's really the fact that we are range bound. We just take it day at a time and see how things are going. All right. So that is my profit and loss scenario. So let's take this to the next level of complexity. We we actually now covered the basic terms in the option market. We talked about the current house price, which is your analogous to what the stock price is at that moment in time. We talked about the contract that allows you to buy the house at a fixed price, irrespective of whatever the current price is. That is called a strike price in the market. There is really no reason why your friend can make a contract to only fix that price for 100K. He could technically make the contract with any number in mind. He could technically make a contract that, hey, I'm going to give you the right to buy a house at 110,000 in the next 1 year, and so on and so forth. He could also make a contract with different expiration times. It doesn't have to be 1 year. He could make a contract which expires in the next 1 month. In other words, only giving you time for next 1 month for the market to appreciate, or he could make it for next 2 years. And that's precisely how the options markets are. In fact, in the US option markets, you have options nowadays which expire literally with 1 day to expire all the way to 3 years. Unfortunately, the Indian stock markets and option markets are not as liquid, which is kind of a shame. I hope in the future they do add at least a weekly expirations. I believe they are monthly right now, but yeah, that remains to be seen. So the bottom line is all these contracts at different strike prices and different times of expiration. That is what will make up an option chain actually. And we are only focused right now, like I said, on the call option chain, giving you the right to buy. All right, so I am going to again go back and look if there's any questions. All right, that's good. So next, what I've done here is I have made a really simple table, really dumbing it down to what an option chain might look like, really going back to this house analogy. What I've done is I have made two different chains, one with a 1 year expiry and one with a 6 month expiry. What I've done is I've added four different strike prices. Again, remember the strike price is nothing but the fixed price that you can buy the house. Strike price, fixed price. So that's an important term in the markets. And then on the right hand side, you can see the contract prices for those typical strike prices. And then again, this is for 1 year. And then I've made the same table for 6 months. Again, the house price in that instant of time is at 100K. So we are looking at that instant of time when you're buying this contract. So let's talk about why these are changing and what's the mechanics behind it, other the physics behind it, right? So the most important thing to understand is the risk is what dictates the price. The more the risk, the more the price. Think about actually a very another really simple analogy is the insurance markets. If the insurance company perceives you as a higher risk in you have had like a bunch of accidents in the previous 2 years, they're going to perceive you as a higher risk and actually charge you more premium. Same sort of thing. So once you understand that it's all related to risk, you can start thinking through this now really easily. So let's talk about a 1 year expiration now. Focus only on why this is how the strike prices are actually modifying this contract. Let's first talk about the extreme case in which the strike price is 110K. So the probability your friend thinks that in the next 1 year the house might appreciate, but it's probably not going to appreciate more than like 103 104 is what his thinking is. 100K is like way far of a number according to him. So that's why the risk according to him for that is low, which means the premium that he gets to charge you is also lower. And that's all it is really. Think about this in terms of buying and selling. How would you make a profit? You would need that house to actually go all the way to 110K and beyond. So, for example, if this house goes to 113K, that's when you're going to make a profit. You actually buy it at the strike price, which is 110, sell it at the market price which would be 130, and then make a profit of 1,000. But that probability of that happening seems to be really low, and that's why that's a very low premium. As you can see, the risk of the house remaining at 100K he sees as a, highly likely, and that's why he's charging you a higher premium. The other case which is really interesting is, what if the strike price is below the current market price? And this is kind of interesting because suppose there was no contract, what would you do? You would simply buy the house at 95K and immediately sell it as at 100K and immediately pocket that profit, right? But really, there is no free money. So that contract price must have that 5K baked into it. 5K plus some sort of a time value, which puts that contract at 85, at 8,000. In other words, you can buy the house at 95K and sell it at the current market price, but you have to pay a pretty high premium for that contract. Hopefully that makes sense. So that's the movement, that's the changes in the contract because of the strike price. The contract price is inversely proportional to the strike price. The contract price is actually directly proportional to the expiry time. The lower the expiry time, the lesser the contract. Again, think about this in terms of insurance, right? To buy an insurance for 1 month versus to buy an insurance for 6 months versus 1 year. 1 year is going to cost you more insurance. If your friend thinks that he has 1 year to actually make the house move from 100 to 110K, he perceives, he thinks that's, he has more time for that, right? So it's going to be more probable. And that's why the contract price is higher. Let's take an extreme example. What if he makes a contract for the house to move from 100 to 110K? So 110K strike price in the next 10 days. So that's highly improbable for that to happen. So he might just charge pennies for that contract because he doesn't see that happening in any way. So might as well make money. Yeah, I'll charge you $200 for that contract. All right. So that is basically the takeaway on, or that is basically the slide on how option contracts are priced in general with different strike prices and different times of expiry. All right, I'm going to go back to questions. And okay, weekly options are available in Indian markets on Nifty and Sensex. Sensex, that is actually really great because, I just trade S&P 500 futures, and that's equivalent to the Nifties and Sensex there. Will we get logic driving the friend's thought process why he thinks the strike price is higher or lower than the current price? So that's a let's see. So that's a loaded question, and that's you have to then go obviously to the option market. So we right now are just looking at basic numbers, right? Understanding how these options are priced. What's going to happen is the option market is like well balanced. So there's going to be a lot of strike prices available, and the market makers who take the opposite side of that will basically move these option prices around based on how they perceive that risk. Again, that is my understanding. I'm not an expert on how the market makers actually work here. But we will keep on exploring that question, Vinay, okay? The next is to confirm if the house never reaches the strike price and the contract term expire, my loss will only be the contract price. That is absolutely right. And actually, I'm going to jump a bit ahead to answer that question. I'm actually going to show you how the risk graph looks like. I was going to show that last, but actually, this is a perfect time to do that. So just note that the x-axis is a bit modified. I made this for like $100 stock price, but think about this as multiplied by 1,000. So basically 100,000 is right there. And then the payout is basically multiplied by 10. So this is your risk graph. And you absolutely said that correctly, that if the house remains at 100,000, your losses, or even if the house goes to 80,000, your loss is only going to be limited to that 5,000 that you paid. your loss is going to start going lesser and lesser, and your break even is going to be 105,000. And that's when you're going to start making a profit almost one on one. Your friend is actually on the opposite side of the market. He can only make a profit of 5,000 here, but he's going to start feeling the pain as the house starts going up and up and up, and technically could go to infinite. Okay, so why is it 8K for 95,000? So 95,000 strike price. If market is crashing, should it not be less? So again, at that instant, in a fair valued market, technically speaking, nobody knows what happened. And markets are fair valued is basically what it is. So for example, right now the house is priced at 100,000. Technically, there is equal possibility that the house could go up or down, a 50-50% probability. Nobody knows. The markets are crashing. So what's going to happen is, in that case, the options are going to be priced accordingly. The prices are going to be elevated. What happens is market crashing, in fact, is a risk. And going back to our risk argument, let me go back here. Risk dictates price. What's going to happen is when the as the risk starts increasing, that contract price starts going up and up. But as of that instant, this is what the price is, if that makes sense. It's an instantaneous price of what the understanding is. These are really good questions. And again, so my what the thinking is, these are just we are trying to understand and build the building blocks of how options are in terms of just some reasonable numbers which I'm showing here. Once you understand how these prices are, you know, how these prices are priced, how they change with different expiration period, we are then going to go into more details of how they actually move, and then basically just talk about some of these questions you have in more details soon. All right. Right, let's see if there's any question. Risk goes up, premiums go down, right? It's the other way, right? Because it's like an insurance company. The insurance company's risk, the what they perceive as risk, they are going to charge you more premium. So if your friend thinks there's a very high risk of the price actually going up, he's going to charge you more premium. The risk is always related. It's more the risk, more the premium. Always think back to the insurance company. All right. All right. So next, let's talk about a more convenient way to make profit. This is how actually we deal in options markets. So first and foremost, this buying and selling the house that we have been talking about is really very, very tedious. It's so much paperwork, etc., etc. Same with buying and selling shares. Instead of that, there's another way in the options markets that you make profits. And that's the interesting part. What happens is the contract price itself is going to start moving as the house price moves. That's the key. In other words, the contract price itself is dynamic. It will react to the house prices. For example, if the house is today at 100K, the contract was 8,000. If the house suddenly goes up to 110K, this contract is also going to go up. So instead of buying and selling the house, you can actually buy and sell the contract itself. And that's what I'm going to show you, like how that works. What right now we are focusing on to make things easy is basically just the time when you buy the contract and the time after, right before the expiry. What happens in between is what makes this really interesting. Like instead of 0 to 1 year, what happens in 2 months if the house price goes up suddenly? What happens to the contract in, say, 5 months? That's when things start really getting interesting. And that's what the next part of this lecture is going to cover. But let's now try to understand how this contract moves with the house price after 1 year. So let's again go back to our base case. The house price is currently at 100K and the strike price is 100K, right? So that's our base case. You paid 5,000 for that contract. Your max loss is always going to be 5,000, no more, no less. What if the house goes to 120,000 again in the next 1 year? So we already spoke about this, right? The profit from this trade was the difference between the house price itself, which is 20,000, minus the 5,000 that you paid. So the profit and loss from this was 15,000. That's exactly what the contract should be reflecting. So in fact, what's going to happen is that this contract itself is going to go from 5,000 to 20,000 to basically reflect the same profit that you would have got by buying and selling the house itself. And that's how you basically trade the option markets. You are buying and selling these contracts instead of actually physical shares. So let's look at another example here just to add clarity. So let's look at the strike price of 110K. If the house goes to 120K, the profit from the transaction is going to be 10,000. 120 minus 110 minus the premium that you paid, which is 8,000. So the contract itself is going to go from 2,000 to 8 to 10,000. You buy the contract at 2,000, sell the contract at 10,000 to basically make the same profit. So hopefully that adds clarity from now to 1 year. What happens? I'm going to elaborate again. What happens in between? What if the house goes from 100 to 120K for this strike price, say in just 6 months? So your profit in that case won't be really the whole 15,000, but some number in between based on these complex options pricing formulae. And that's basically what the whole, the whole interesting stuff starts. That's what we will be exploring next time. The options pricing and then tying this back to the options markets. All right, checking back to see if there's any questions. Uh, all right. We can sell. So let's talk. So which contract are you referring to? Are you, as the contract was 1 year? Yes, hold on. So you can. So let's talk about this contract. Can you take this contract and the house price goes to 120,000 in 6 months? Can you sell it in 6 months itself? Okay, 95. Let's talk about the 95 one. So suppose the house goes from 100K to 120K, not in 1 year, but say 6 months. What's going to happen is the contract is going to go from 8K, not to 25K, but some number in between. It might be like 19K or 18K because there's this time value that is embedded in it. Remember, I said time was a commodity, right? That's exactly what I mean by that. Same with the 100K. If the 100K house went to 120K in, say, 6 months, the contract will go from 5,000 not to 20,000, but maybe, I mean, I'm just making up a number, maybe like halfway in between. It might go to like 13,000. If the house did that in just 1 month, it will be probably even less. The contract immediately will only go to like, say, 9,000, and then it will keep on going upwards and upwards as you go towards the expiry period. Again, that's the next level of complexity. I'm going to elaborate. This is like we are building, these are just building blocks right now. So you are actually asking absolutely the right question, folks, here. That's the next level of complexity, how this option market moves, not just with the stock price, but the time as it ticks away. In fact, that takes me, so I already covered this graph, so I won't go here again. That in fact takes me to the key variables that we discussed again as a recap. we already talked about the strike price, which could be any number, pretty much any number. Same for the stock market. If the Apple stock, for example, is right now trading at $250, you're going to have option contracts right from $150 to like $350 and even beyond. And they will be like really finely discretized. They will be probably like $5 away. So again, we are going to actually look at some real option chains later in this series of lectures. Same thing with time of expiry. Somebody pointed out nowadays the Indian markets Nifties have 1 week, minimum 1 week, and maximum probably same like 3 years. S&P 500 has right now option markets or options that are even 0 days to expire, like expiring today itself, all the way to like 3 years and beyond, with 1 day discretization. So important to understand, by the way, that once you buy this option or once you buy this contract, what's going to happen is time. The physical time is actually going to start ticking from times physical time zero to all the way to the expiry. So, for example, for the 1 year contract, you start at zero, 1 month, 2 months, all the way. So that itself becomes another variable. Then there's another variable we haven't explored so far, which actually dictates of options markets. We talked about it, but really haven't looked into it. Again, tying this back to risk, right? Remember, the higher the risk, the more the premium. What we call that in the markets is volatility. Volatility increases when the prices, like somebody pointed out, when the prices actually fall down. People are panicking. Absolutely. Volatility goes up. Right now, the markets have really high volatility. In fact, option prices are highly elevated right now because of the Iran crisis. Volatility increases when there's uncertainty. For example, the when there's earnings tomorrow, nobody has any idea what the stock is going to do. So volatility is really jacked up, and the option prices are actually elevated. And then same with, with there's like a macroeconomic event, like there's a interest rate announcement tomorrow. Again, nobody knows what it's going to be. That's when the option prices are going to be jacked up. Relating this back to the house prices, if this house is in an earthquake zone, or if there's like a town hall meeting which is going to be in like next 5 months in which a decision is going to be made. Hey, is there a tech factory that is going to be set up in this area or not? That decision has not been done. So indecision means high volatility, high uncertainty, and high risk. All right. So let's time for taking questions. And yep, absolutely. Time is an important commodity, like I said, which we are going to explore. And is the risk for it is risk for the home seller, right? So I'm not exactly sure how I understand this, but the home seller wants the house prices to remain below a certain level. That's when he'll make a profit. Sorry, did I get that? Did I get that? I'm not sure I got that question correctly, to be honest. It is, can you elaborate on that perhaps? It is a risk for the home seller. Um, all right. So I'll skip that one, but feel free to text me and I'll try to, reach out and answer that for you. All right. So, so I'm going to actually skip this concert analogy because I thought the house analogy was much better. So I guess where are we going next with this? So we will be applying this exact concept to the stock markets now. We will now shift to the stock markets. And then we will, like I said, explore how these options are priced, how they move in much more details. And I actually have some really interesting spreadsheets that I have that actually show how these move, how you can actually make a profit. And then we will be discussing everything in terms of the profit and loss curves, just like the one I showed you right there. That's how we look at always option trades, profit and loss curves, how they evolve in time, how they evolve when volatility changes, etc., etc. So This is kind of all I had for this lecture. I'm just really going to quickly kind of give a flavor of what the next lecture is involved. And I plan to basically do this next lecture, hopefully either next week or the week after that. That will give, everybody sufficient time to look at this video again. That video is going to be in the live section of my YouTube channel, but I'm also actually going to make a video in which I edit it a bit better and add some takeaways. So feel free to look at that also in the actual next week. We'll be doing, or rather the week later, is uh, discuss about exactly this, that hey, we don't, suppose we don't have the capital to buy 100 shares. Can we actually replicate that movement by buying a call option? That's what we are going to be talking about. And then basically same thing, analogy to the house. Current stock price is at $100. You can actually pay an option premium to buy 100 shares, so giving you the right to buy. This is so an option contract, just to this is the right time to say it, is always going to be worth 100 shares. So this option premium could give you the right to buy 100 shares at a fixed strike price. Remember, the strike price could be 90, 95, pretty much anything. That is going to lock in the 100 shares at that price for, say, 1 month. So that's the analogy now we are going to start drawing to the stock markets. So why don't I go through this last one as a flavor for the next week and then take more questions if there's any. So why would you do this? Simple, right? Buying 100 shares, this is going to be your capital, 100 times 100, which is 10,000. Suppose the stock goes up to 115, your profit is going to be 1,500. And what I actually forgot to do actually in this was include the premium here. So my apologies. I'm going to correct that in my actual lecture. But take the $500 out that you paid the premium, and your return on investment is going to be 10%. Oh, I'm so sorry. My apologies. Let me take a step back here. I'm buying 100 shares, those, so there's no premium here. My apologies. This is actually correct, right? You buy 100 shares and you sell 100 shares and you make a $1,500 profit. That's a 15% return on your investment. But buying a suitable call option, you're paying $500 for that, right? If the stock goes up to 115, that's your profit minus the 500. So you make a profit of 1,000. But that profit of 1,000 is actually only on an initial capital of 500. That's almost a 200% rate of return. So again, the takeout, this is a very simplistic way of looking at it. The bottom line is options when correctly used, and that's what we are going to be exploring, will allow efficient use of capital. And even if you make part of your portfolio with options, for example, 80% of your portfolio is just your normal dollar cost averaging, or what they call in India, I think SAP. SAP. If you have 80% of your portfolio doing that and 20% of your portfolio actually trading options, you are pretty much enhancing the return on your entire portfolio. And that's the approach I like to take in my own sort of equity account. So that was kind of the flavor I wanted to give you guys and a thought process before we actually start digging into some of the option pricing models. And just for fun, let me actually show you one of these. So that's what we are going to be discussing about next week, an option pricing model. Right, so I'm actually going to end this and see if there's any more questions anybody has. Uh, Again, thank you so much for joining. And if you can subscribe and turn on notifications, then you will automatically get notifications of when I go live. And you can actually post questions on the community chat, which is really great. Um, so yeah, let's see if there's any more questions here. The risk means he's bound till when it goes up. not sure I can understand that question. Can you reach out to me? We can have a one-on-one and we can chat about that. Safest option to make money 70 to 80% of the time. That's a loaded question. But I'll tell you what I do, and that's what we are going to be exploring later, is the bottom line is I strongly believe in the dollar cost averaging process. Keeping a fixed amount of dollars every week, etc., to build out the compounding. We know that S&P 500 typically has returned about 8% on an average over the last almost 100 years. Some years it's like down, but some years it's 20% up. So you keep that going. And then 20% of the portfolio, if you use options on some shares that you actually in the long term, like Nvidia, Apple, to make more profits on that is what I typically do personally. The other thing I'm going to be talking about is selling options, which is, pretty much after a few lectures. That's one way I make money. And in a sense, try to make a profit, especially when the markets are flat. And that actually is a lot of good, the probability of that is pretty high. Okay, so is ROI a way to look at option transaction? Is there a number for ROI that you like? I mean, this is again simply right now, it is just a number on showing how your options add leverage. Typically, yes, absolutely. Like, for example, 80%, again, going back to the 80-20 split, right? If you're making 10% on 80% of your portfolio, but the 20% of portfolio, because of leverage, you're actually making 30 or 40%. Then you weight that portfolio out and you actually will be overall at a higher rate of return. That's kind of what I think you're asking. But again, reach out to me if that did not answer your question, and we will go from there. All right, I'm looking at WhatsApps if there's any questions here. Okay, looks like not. All right. Any last minute questions? And like I said, look at the community post. I'm hopefully planning to do the second part of this either next week or the week after that. This video will be on the live part, and I'll make a different video on the normal playlist with a lot of takeaways, etc. And then, yeah, thanks for asking so many questions. I love the engagement, and see you guys next time. All right, so live.